What's up, traders? Anthony Crudele here, and welcome to the Futures Radio Show podcast. Today, I'm joined by Jason Ruchel, a seasoned options trader and writer for Options Talk. We're breaking down everything you need to know about trading options on futures, from the very basics to more advanced strategies. Jason will share how he incorporates options on futures into his trading, explain the key differences from SPY and SPX options versus ES and MES options, and offer expert tips on selecting the right strike price and expiration. We'll also explore the unique advantages of options on futures, like overnight market access, and how they can be a game changer for hedging and managing volatility. If you're serious about elevating your options trading, this episode is packed with insights you don't want to miss. Let's get started. Today's podcast is sponsored by TradeStation. As a futures trader, you can leverage your portfolio even more thanks to TradeStation's reduced margin rates across popular futures products, including intraday rates as low as 10% on select U.S. index futures and low rates on popular energy futures like heating oil and gas. Open an account today and access over 600 CME Group futures products and customize your trading strategies on a sophisticated platform built for advanced traders. Visit tradestation.com/Anthony to learn more. Jason, welcome back to the show.
Good to be here again, Anthony. Thanks for the invite.
Great to have you here. We're going to talk about options on futures today. Really a topic that's not talked about, I think, nearly enough. I know everybody's out there in the options craze with zero DTE. Everyone talks about SPX options every day. You see it out there, but not enough people talking about E-mini S&P or micro E-mini S&P options.
Yeah, I mean, they're becoming way more liquid now that we have zero DTE on almost every index or ETF out there, especially the SPX being popular because it's 10 times the size of SPY. But if you want to get smaller, you could always use the MES micro futures contracts, which are basically the same size as a SPY spider ETF option. So it just depends on, what kind of trader are you? Are you just messing around with one lots, or are you trying to do more than 10 or 20 at a time or whatever? But there's just so much liquidity in those, not just for zero DTE, but a lot of times I like to do 7 DTE, 1 week out or something. If I'm hedging an event like last week, we had FOMC. So it was pretty easy to actually just put a little bit of money into like a put or a put spread if you wanted to hedge and not have to go out a month or two in time and pay up in hedging costs. So,
yeah, I mean, there's a lot of benefits to the futures, and we're going to get into that, but I want to start off with just the basics of options. I think that so many, younger traders, newer traders, we have an SPX craze with the zero DTE, and I feel like so many people get so hyper-focused on that when they come into options. It's funny, I have a Discord, and I talk with so many traders, and so many of them really just focus on that zero DTE game versus just understanding options as an overall tool and when they should use that tool. You're someone who obviously with Options Hawk, you're an option specialist, so you understand options, in a way that most people probably don't. They're coming in and just trading them and not knowing them. What are the basic reasons for someone like you or for anyone out there who understands markets and they understand their strategy as to why options is such a great tool to use and going beyond just zero DTEs?
Yeah, so I guess the basic premise of it all is the fact that they're dynamic deltas versus static deltas. So if you compare 100 shares of SPY, for example, or one futures contract, you're going to get the same delta movement or per share equivalent, whether the market goes up, 10 S&P points or down to 10 S&P points. But when you're buying a call, let's say you buy an at the money call, right? That's 50 deltas generally. So you're going to have the exposure of 50 shares of SPY, but if that underlying goes lower, you're only going to lose that 50 shares of SPY. So that delta equivalent is going to cap your risk. You're going to define your risk by buying a call. If you're long stock or you're long futures, you're just going to keep losing $50 per point the lower it goes. Same thing on the upside, of course, because you have unlimited upside. But the nice thing about options is that once they start going in your way, like let's say you're up 50% on an option or 100%, you can adjust your strike higher. So if you bought the 100 strike call and now it's at 110, well, you could sell your 100 call and then buy the 110. Now you're adjusting your strikes higher, and it's kind of like locking in a win already, right? And staying exposed to the upside. That's what I see a lot of institutions doing on a daily basis with winners, just riding trends higher and focusing on that exposure to the upside as long as the trend is higher.
So for someone like you who trades outrights and options, give us an example of when you would say, look, I think S&P is going higher. I'm going to go to my strategy and I'm going to use an option strategy versus just being outright long, even the S&P or SPY or SPX.
I guess it really depends on the underlying and what kind of, market environment we're seeing. Like every week I kind of start the week or even the prior week, Friday at the close, you can actually see what the expected move is for the S&P for the following next week. Really any expiration out there, you just go to your options chain and you can actually see, I think the start of this week had a 75-point expected move. And when I say expected move, that's just what the options market is implying for that time frame, right? For 1 week. Last week, it was over 100 points because we had FOMC. So the range expected by the market was higher. So it really just starts with what the market is expecting, because about 70% of the time, or that one standard deviation, is what the market is pricing. So you want to be at least expecting prices to stay within that range, or if you're bullish, maybe target the upper end of the expected move. So if the S&P was looking for like a 100-point expected move the rest of this month, you could buy a call spread and situate your short strike at something like the 20 or 15 delta, where the upper end of the expected move is expected to hold. At the same time, you're going to have upside up until that point where that strike is hit. So you're kind of defining your risk, but also at the same time having a low cost way to enter into a presumed up move if that's what your bias is. And the same thing to the downside. You could kind of look at that expected move. Like last week, I was pretty sure we weren't going to break below 54.50 on the S&Ps, even if the Fed threw us a curveball and markets sold off. We just had that like 2-hour sell off, and then the next day we gapped higher when the market and really the global markets gapped higher, thinking like this Fed rate cut is kind of what we expected, and we got what we wanted to hear. There was no tape bombs or landmines. So I continue to kind of think the market's headed higher into Q4 just based on seasonality in election years. You very rarely see sharp drops ahead of November during an election year. We can't count 2008, of course, because that was a different scenario. But yeah, I mean, I'm a buyer of dips for now, as long as this 5,500 area on the S&P is holding. So using November, December call spreads on the S&P, or I think the small caps are going to continue higher, but overall, just using call spreads to play the upside into year end, I think is going to be a really good trade.
Yeah, so let's go over criteria as to what would get you into a call spread. I want to go over for everybody here just to understand, because obviously this is futures radio. I'm going to focus more on the futures. So for me, anytime I look at a trade, I'm always looking at, what's my distance of stop? How wide of a risk margin do I have to be right here, right? How long do I have to let this play out is also a factor, right? Should it happen today, tomorrow, next week? And then I'll look at, what the targets are, right? So I kind of work my way from stop to time to potential distance. And then I find my way actually moving into options on futures a lot more lately, because I'm able to, I think, better risk manage my positioning, have a stronger hand in the market, because I don't have to worry about that stop overnight. And I'm directly connected to the underlying E-mini S&P prices, which I think is not stated enough versus like the SPX, where like, the SPX, a lot of people are charting SPX. I get that, but you have a ton of people that are charting E-mini S&P, and those prices and targets, which is where I do all my charting, you can directly trade them on the options on futures. And so then you have the micros, which is going to be the same price as the ES. And then now it's just a matter of how do you want to, what's your contract size based upon that. So for me, my criteria for my time frame for a trade to work out fits into options a lot more than outrights. Because you go look at even today, you and I were recording, on the 23rd here. It's just a grinder day. I think S&P is going to continue to go higher. If you're in outrights, you might have been long 10 times today and got chopped up. But if you were long options, you probably, where you started the day is probably where you ended the day, most likely in your P&L, because the market didn't do much. And to me, that's a stronger hand in the position, because I think it's going to take a little bit of time and like a bumpy road. So let's peel it back. Let's talk about time frame and conditions and criteria that you have to where you sit back and say, okay, I want to be long. I'm going to look at call spreads. How does that trade play out?
Really, it just kind of depends on what's the overall implied volatility of the market too. And the best way to just gauge that is by looking at the VIX, which today closed just under 16, it looks like. And not a lot of people know this, but 16 is that level in the VIX where it's pricing in 1% daily moves as a range, right? So that's historically the average norm. During bull markets like this year, we've been slightly below that for most of the time, but then we see these spikes higher above 20 that don't last too long. But it really depends on, am I willing to buy a long call or something, or a long put if I'm hedging? It depends on that IV. And, to go even, you could go even further into it by looking at the skew of options, right? So there's always more risk to the downside in most stocks, especially the S&P. So put options are always going to be priced higher than call options. It's just a fact of life, right? The risk is always to the downside, as we saw August 5th when Japan fell out of bed. But the market is always going to tell you where it sees risk most by looking at the implied volatility of the options. If implied volatility was high, like, August, early September, we had the VIX over 20, 25, I'm going to be using a lot more spreads because volatility risk is higher, right? If I buy a call or a put for that matter a month ago, and the VIX goes from 30 back down to 20, you're going to get crushed on anything you buy, even if you got the direction right. So implied volatility is always kind of number one when structuring an options trade. And then, of course, looking at the chart, the direction, and just overall, what's the catalyst? What's the reason for my assumption, whether it's up or down?
A question here for you got a lot of traders that are probably going to be new to options. Which one is more important, direction or understanding the volatility?
Well, I guess it kind of depends on your time frame and how long you plan to be in the trade, right? That's kind of a big thing as well. Like if you're just day trading, then it's always going to be more direction because the delta is going to drive the price of the contract that you're trading quicker, right? So if you're buying just an at the money call, expecting a rally, you're going to need the direction to be right for that contract to change in price in your favor. But if you're looking to trade earnings, or if you're looking to just hold something for a month or two, sometimes, like for example, I'm trying to think back. I've been I'm not a gold bug or anything like that, but I've just been following the trend higher in gold and silver this year, and it's been just kind of a grinding move to highs for gold. GLD specifically is kind of the path I've been using, and really, I've been holding November and December calls and call spreads on GLD, and every now and then this summer. This is since probably June, July, early summer. And every now and then you wake up and gold is down $20 or, whatever. The dollar's higher, so metals fell, right? Gold futures are so leveraged. It's just like good luck if you're playing the move through gold futures. But I was able to hold on to a pretty decent sized position in GLD call spreads that had a November and December expiration, and they more than doubled. So I kind of took off most of my position last week into that spike for FOMC. And I got some longer term stuff on, and IRAs and stuff still there too. But it really just depends on how long you're looking to hold on to a trade, right? And that's going to dictate what's more important, the volatility of the options or the direction of the trend. So
Well, I know that we have definitely more day traders listening to this than
yeah,
anything. So I want to maybe stick to there. Let's talk about, first off, I want to say, obviously I agree with you on the gold future standpoint. If you're just trying to stay long gold futures through this whole rally, it's going to be nearly impossible. But there's also options on gold futures as well. And CME Group has continued to expand their products for you got micro golds as well. So I think it's just another thing it comes down to, this is where, I have conversations with you about options. And the futures markets, what's great about them is that, and I said this with the E-mini S&P versus SPX or even SPY, is that most people are charting the price of gold or the price of S&P through futures. And so you have a direct correlation with your strikes and all that stuff in the options market. And you do have multiple choices in terms of what options are available size-wise as well.
yeah.
But I think it's extremely important what you're talking about. That's why I was going through the criteria of like, what is it that you would look at in terms of how you would approach a scenario where an outright person would then go and choose an option? And to me, it sounds like, obviously you have to think about your time horizon and what is the implied volatility coming up. And then if it makes sense to go into the options versus just like trading in outrights on a day-to-day basis. But back to the day trader aspect of it, I want to say an SPX versus like SPY. When you come in on a day where you look at SPX or S&P and you think that the market is going to have let's just say a volatile day, right? You look at it and you say, you know what, this thing is just, it's moving. Is there any advantages to almost just trading the zero DTEs, maybe over the outrights, just because the options markets maybe don't have a clear direction, but there's a lot of volatility in them? Because maybe there's a lot of days this year, and I think probably going forward, especially in S&P and NASDAQ, where we're going to have a lot of two-way tapes. Is there any advantages in just being in options outrights, just trading them almost like a future?
I completely agree with that, especially because now they're just getting so much more liquid. And just to kind of piggyback on your last question, the other thing I would consider besides direction and volatility is liquidity, right? Because if you're day trading, you need to be able to get in and out quickly. And without question, the SPX and the SPY have the best liquidity on the globe because the volume traded there is second to none, as you know. And since I do have like a full-time gig at OptionSock and we're just focused on creating content and sharing option flows with members, I don't have a ton of time to day trade throughout the day. But on busier days like, FOMC last week or the first hour of the day, I always try to gauge where that opening range is and what price is doing after the first 15 to 30 minutes, while also looking at breadth. Remember a year ago when we talked, we discussed breadth a lot because it's a big factor in what I try to track throughout the day and throughout the week, really. But if breadth is showing me signs that there could be a trending up day or a trending down day, just based on metrics that I've kind of identified over the years, then that's going to be a great day for zero DTE trading and specifically the options and not the futures, because I believe that zero DTE and even like weekly options are notoriously underpriced because the market doesn't make big moves each day that often, right? It takes a catalyst or it takes some kind of a news event, which might only happen once every week or two. A jobs report, a CPI back in the day. And now, just different events like FOMC or, Fed speakers. But overall, the options are underpriced, I think, on the S&P. Like the last 2 weeks, if you look at the expected move, we surpassed the expected move for the week based on realized volatility. So that makes the options the better bang for the buck because of one simple factor, and that's gamma, right? So gamma is another geeky options statistic, or Greek you want to call it. And it basically is just going to tell you how fast the delta is going to move of your underlying option. So if you buy a 20 delta option, whether it's a call or a put, the zero DTEs have the highest gamma available because if prices move fast enough, then that 20 delta call is going to move to a 40 delta call and then a 50 delta call becoming at the money. And all of a sudden, you kind of see those deltas grow teeth, and that's called gamma. And that's when you could really see big returns. You could buy an option for $1 on the SPY. And if it goes your direction, you could be closing at $5 or $6 by the end of the day. Of course, everybody wants that to happen every day, so it doesn't, right? So you have to pick your spots and understand, okay, maybe, this is the third day down after a little bit of a dip and, we had a washout at the open. Maybe this is the day to buy some calls because we're right at support. People hate the market now. And there's a really good chance that we could bounce back for a day or two, right? So that's an example where you might want to take a swing on a zero DTE call and, you're risking the debit, right? Don't have a stop loss. That's what options are for. That's what I wish I knew about options 10 years ago when I was starting out with smaller amounts of money, because buying an option for $5 and then watching it go to 4 or 3 shouldn't worry you that much if your position size is okay, right? If you're day trading or scalping, your position size might be a little higher or larger than it would be if you're holding overnight. But still, I am a big proponent of, like, when I buy an option, I'm kissing that money goodbye because it's out of my hands now and it's in the market's hands. And yeah, I took the trade because I have a setup that I trust and I believe in, or a signal is telling me to take the trade. But if an option goes from 5 to 4 to 3, I'm not going to sweat it because I know I was willing to risk that $5 debit, right? So that's the kind of mindset you want to kind of have in your head when you're trading, even day trading, and specifically when you're buying options, because a lot of people just over leverage, and it's pretty easy to say, oh, if I put 10 or 20% of my funds into this one option and it loses 50%, well then yeah, I'm going to feel compelled to use a stop loss because I didn't want to lose all that money at first. So it just goes back to your position sizing. And I think over the years, like being able to stomach 1% to 2% position sizes going against me is not going to make me sweat because I accepted that risk before I hit the button, right? And then being in that position allows me to breathe and let it work for me. And the other big thing a lot of people that day trade don't realize is that you miss a lot of overnight gaps if you're only day trading. And I feel like a lot of my profits come from riding trends that end up gapping in the direction of the trend. There's nothing wrong with day trading. I kind of like use it as an engagement tool. And maybe even, let's say I'm pretty heavily long and we come in and gap up or something. Maybe I'll buy some puts that day to kind of hedge my core holdings that I don't want to necessarily all dump right there, right? Because I think we're going to be higher in a week or two or three, but we're pretty stretched short term. So maybe I'll day trade to the short side that day and kind of not get so upset if the market fades back to fill the gap or whatever, right? So it just really depends on your time frame, your position sizing, and what you're able to stomach dollar wise, I think.
So many things to unpack there that I think are so good for traders out there. Number one is I've been using them for several years now, and I know a fraction of what you know about the options market, right? But I've learned to be able to find times when the options just make so much more sense for me as a trader. Now I'm mostly trading S&P. I'm trading some Russell options these days, a little bit of NASDAQ, maybe some gold and oil. So I'm sticking to like the major products, and I'm only buying options. I'm not selling them, and I will do some spreads. But nonetheless, for the little bit of knowledge that I have, obviously I have market knowledge for a lot of years, but understanding a little bit of knowledge of options, there are certain times where zero DTE to me just makes the most risk sense. People look at them as like, oh, people are just slinging zero DTEs. No, I like them a lot of times over a futures. If I'm trading an option on future, and I think that the market's going to be trending in that direction, I bought that trade. And that's so important what you said. It's so huge for me mentally because I'm healing. I've let that trade go. If I think the S&P or Russell is going to trend up that day, I will buy an option and I will put my risk on, and my position size is relative to what my future size would be because the options on the futures are going to move the same tick value. Now they're not going to move as much as the futures, but I have a great risk versus reward by using a zero DTE option on future. I think it's a directional trade, and I can day trade that because, like you said, liquidity and all that stuff. But if the market were just to snap against me, and let's just say we're to go in an S&P trade, I would normally have a 5-handle stop in it, and it were to rip 10 handles lower. Well, I don't get stopped out. Right? And the difference is if it were to come back, which it seems to do a lot to the upside, I'm still in that trade because I don't need to have a stop. I bought that trade. People don't think that way. So many people try to be so leveraged, Jason, in such a short little box that they don't look at when a scenario for options makes more sense to them. I wish more day traders thought this way because they'd last a lot longer. They're just too leveraged. They're using leverage too much and in the wrong spots most of the time too. I've been there myself versus understanding these great products that these options markets are giving you. And you, like I said, there's micros and different sizes. And when they really make sense to use them for your trade, for you to be a better executor of your trades.
I'm with you. There's nothing wrong with leverage, right? That's the beauty of options and futures, to be honest. I've definitely not traded as long as you, but I feel like I'm at a level now after, I don't know, 10 to 15 years of consistently trying to, make a buck, that you realize longevity and staying in the game is what keeps your mind right and keeps you humble. Because there's definitely days in the past year where I was like, man, I'm an untouchable. And then the market just smacks you across the face, right? So it has to do with position sizing. I always say, I think I got this from John Carter because I've always learned a lot from him over the years. But once you start high fiving yourself, it's time to sell half your position. Realize you don't know as much as you think you know because the market is just accommodating you. Yeah, you were right on the trade, whatever it might be, whatever time frame it might be. But feed the ducks a little bit. Also, take some profits into strength or weakness if you're short, and realize that if you're trading options and futures, you're leveraged. So if the market turns around pretty quickly, then things could change on a whim. I wanted to go back to another thing you said. I know you're heavier in the futures and options on futures. The past year since we talked last, I definitely have dabbled a lot more in those because I was pretty surprised at how liquid some of these options on futures are, specifically like, the S&Ps, gold, oil. Even I've traded some oil in the past year, just calls and puts on the actual CL futures contract. And then also a couple other random things like bonds, or I think like live cattle. I tried it once. Never again though. I won't touch live cattle.
The bond market ones throw me off too, like,
Oh,
because
the fractions? Yeah.
I mean, I'm just like, I'm in this, I'm looking at it, I'm going, I'm not sure, am I even in the right product?
Yeah,
It's
yeah.
it's
I
crazy. That's for a whole nother show, Jason.
Yeah, it's funny though, because like I've made money trading bond options this year because I was bullish really since the springtime, and I started selling puts. I honestly I think the ZB options, they're more liquid than TLT options, and really if you just position size accordingly, like you said, make the equivalent of what your futures position might be, but do it in options so you have the same risk reward and you're not sweating every tick. But I think the ZB options are much more liquid than TLT, which is the ETF for the bonds. But nevertheless, like this summer's been pretty crazy because we had that run up in June, July, and then all this Japan, chaos in August kind of spiked volatility. And that was actually a really good opportunity to use some of these options on futures overnight if you were trying to hedge your positions. I remember back in like late July, early August, around that time when the market was sliding. I'm always pretty, long in the market when we're in an uptrend. So I had a lot of long positions, but I was able to, I think like the prior week when the VIX was right around 18, before it spiked up to 30 plus, I remember the market closed I think it was a Thursday afternoon, the market closed, and it was right ahead of this jobs report we were waiting on the following Friday. So the market was already closed, so I couldn't actually buy any puts on the SPY or something. So I actually went into the micro S&P futures or the micro ES futures and bought some puts just for a hedge because I was, seeing the rising VIX and something didn't look right to me. So I wanted to be hedged. So I bought some puts that were like expiring in 2 weeks, just wanting to have a little bit of protection over the weekend. And then of course this Japan stuff unfolded out of nowhere. And, that's where we saw that volatility spike from 20 up to 40. And then it came down in less than a week, but still, like the puts I bought helped me, sleep a little bit better that Sunday night into Monday when the markets were literally having a little mini crash because the micro ES puts I bought went from $4 up to 30. And I mean, it was a very small position. I think I risked like $1,000 on the put hedge, kind of, on a low 6-figure account. I just wanted a little bit of protection. And I was able to make some money on those puts on the micro futures when the market was closed in the evening. So it's just a nice way to use those micro options on futures or even the full ES size if you want to, because they're very liquid. Now, whether you're day trading or not, the ES and the MES options on futures are a very liquid alternative to the SPY because, for example, the micros are 1/10 the size of the full ES or SPX. And of course, there's a lot of different advantages to that based on taxes and stuff. You know about the 80 or the 60/40 rule. But not a lot of people know that SPX options are treated as futures. So you get the same tax advantages if you trade SPX over SPY.
Yeah. I mean, and you think about it, you have the overnight access to them as well.
Yeah.
And if you want to trade futures directly against your MES or ES options, you have the strike prices that are completely correlated with to what you're charting and what you're trading for futures. There's a ton of benefits to it. I know we covered a lot today, and the goal for me with this was, look at you understand options at Option Talk. You guys, I love your content. It's fantastic, by the way. I recommend anybody, if you're out there trading options, you should go check out what these guys are doing. I consider it the higher level, where mid to high level, where people that if you are out there and you want serious content on options, you guys are, one of the best out there.
Thanks. We put out a lot of content to members on the website and stuff, and we kind of cater towards that more advanced trader that understands options and equities and kind of like focus on that institutional client base. We have a lot of institutions that actually subscribe to Options Talk as well. So it's honestly the last 3 years with the site and working with Joe, I've learned a ton more than I ever thought I would in that short amount of time when it comes to actual option flows. And I'm completely convinced now that options positioning in the market drives future stock returns because there's just so many examples of just in the past year and a half where we saw NVIDIA just wild amounts of call speculation and just big institutional order flow a year ago when this thing was at 400 pre-split, and then of course it split and it's kind of calmed down a little bit, but there's always some kind of like footprints from elephants out there that drive that next move, and Wall Street is just going to piggyback on that and whoever else wants to come on board too. So it really just drives price movement.
Oh, I completely agree with you. As somebody who comes from the outright side,
Yeah.
from the S&P pit and just watching order flow for years in futures, opening myself up to the options world has gave me amazing insight into what future price action should be. I think everybody out there should be learning more and more about options. I know for me, it's a constant education. I think you can go out there and go back to it. There's so many benefits to them and there's so much to learn that
Yeah.
if you're out there and someone who understands just the basics of markets at this point, I would start exposing yourself to options because Jason, I don't know how you feel, but I think that options obviously is we've had a massive growth spurt in the SPX world, right?
Yeah.
That is massive, right? I would say it's probably the biggest growth that we've seen in any other real asset out there, right? But now I think as more and more people are getting into futures and more day traders, you get the people out there with these funded programs and stuff. I think as they start to go to live and they start to trade their own money, options on futures is going to be their best friend. And for me, as I've grown as a trader and as time has gone by, like I said, for me from the beginning, I have found myself using them more than futures even these days, just because I have a stronger hand in the market and they just make so much more sense with my time horizon and other things. And a lot for me to learn, and I'll continue to share that with everybody. But I want to leave on a final note. We've talked about so many different things today about just use of options, the benefits, and all of that. But I want to talk a little bit about the markets with you. You're right there in the trenches, as you talked about, putting out their content every day for all the Options Hawk clients. What are you guys seeing right now coming into the end of the year from the options perspective? I mean, we just had this OPEX. We've got so many things that are past, but so many things ahead of us. I think it's an interesting time right now in the marketplace. What's catching your eye?
Well, I would just tie a knot on that prior comment is like the SPX options complex is growing tenfold year after year, especially with zero DTE now. But just Friday, we saw the first signs that that could expand into the crypto ETFs and Bitcoin. BlackRock got first approval for the first Bitcoin ETF getting options. I'm not sure what day they're actually listing, but I believe that's going to be a huge, retail is going to love options on Bitcoin ETFs because they don't have to go into the crypto market and, pay fees on Coinbase, or you don't have to go to the spot market now to trade Bitcoin. Now you could probably do it just as liquid with these options on IBIT and who knows how many more ETFs. But I think I'm not like a big crypto, like 1 million guy, but I think it's going higher. I think you probably get 100,000 sometime in, early next year, if not by the end of the year, if this thing starts breaking out over 70,000. Definitely seeing some more action in stocks like MicroStrategy since they split on the option side. But overall, market wise, I saw, we do a lot of seasonality statistical work. And really, if you look back the last 90 years during election years, it's very rare to see a correction greater than 10% anytime during an election year. And what we saw in August was 10%, and it lasted for about an hour and a half. So I really think the lows are in for the year, knock on wood. I think the market is just going to climb this wall of worry as long as the VIX stays under this 18 to 20 level, which is kind of what you want to watch for now. But at the same time, I don't think the VIX is going 12. I don't even think it's going to go under 14. Volatility is going to stay elevated going into the election because that just has to happen, right? There's uncertainty. And as long as there's uncertainty, volatility is going to stay higher. So we could see this kind of scenario where the market goes higher and volatility goes higher. So it's almost, I don't want to say parabolic blow off top, but we could see SPX over 6,000 by December, if not higher. It's really only like 5% away, to be honest. And I think, breadth is just expanding. We're seeing broad-based sector participation more so than we did in March, April, May. And that's what I love because I like to track cumulative breadth. And the last 2 weeks, as the market just kind of like waffled around, breadth on the NYSE is making new highs almost daily. So that gives me confidence to be able to buy dips or hold stuff longer term going into Q4 because even myself, the natural inclination is that, oh, the election is coming. I don't want to be long anything, right? Because there's so much uncertainty. But if everybody's thinking that, man, the market is just going to probably grind higher to new highs. And technically, there's nothing wrong with the charts. Yeah, there might be some divergences on indicators, but we know that can last for months. But bull markets and, especially a tech AI driven bull market, I think it's going to continue higher and it's not going to end with a whimper. It's usually going to end with a bang, right? And those have to be, you always want to wait for something weird in the market, right? Like to signify a bottom or a top. I just don't think we've seen anything weird on the upside. We haven't seen euphoria. We haven't seen people just FOMO buying like in 2021. So to answer your original question on what we're seeing at Options Hawk is we're seeing a lot of overall opening put sales in stuff like the QQQ ETF and IWM. Specifically today, somebody sold $5 million worth of puts for next year, thinking that there's really a floor between this 200 and 220 level in the IWM, which is the small cap ETF. But last week, I was really impressed to see the NASDAQ with November put sales, at the money put sales. So that tells you some fund or a group of funds is very confident that dips are going to be shallow and they're going to be bought going into election time frame. And really, if we don't see the typical September sell-off, and I think the market kind of front ran that because seasonality is well known and September has been weak 4 straight years. I think we're going to be higher this September. We got 5 days left, I think, on the calendar trading wise, and it's technically a green month right now. So the market, I think, is going to close higher 3 months from now, but it could, still kind of waffle around and get choppy. But we're seeing this rotational market. That's what I'm trying to say. So, sectors like industrials, utilities, financials, I think are going to be the top performers for the rest of the year. And throw in some tech winners like, Meta hit new highs today. I think Netflix did. Amazon is back towards 200, and now Tesla is back to 250. So if Tesla could break out over 250, that might really start getting some speculative juices flowing in this market. Because as we know, Tesla is kind of like that original meme stock from 2020 that got retail traders really excited. So I still think you need to see a little bit more fervor from retail traders to call a top in this market, which could actually end in some kind of a blow off move into December, January.
Yep. I think I agree with so much what you said. I'm excited to see what the end of the year brings. And
Yeah.
Jason, it's been great to have you back on the show, my friend. I love your work. I continue to follow you guys and just appreciate everything that you guys put out there. And yeah, man, it's been a blast. And I hope people really sit back and listen to this interview and really start looking at options more. I mean, that was my goal from the beginning with you and I. And you did a great job explaining to people the basics of options, understanding them and how they can use them. Until next time, my friend, can't wait to have you back on.
Likewise. Thanks for having me again. I had a lot of fun. So hope you have a great rest of your night.